This is with you, Nick. Now, we've just heard from Nancy that she thinks the resource sector is going to be a dud next year. Your surprise will be a little bit more encouraging, I think, for the South African investors who are listening to us. You think that despite this, so despite the resources sector coming under pressure, continuing to come under pressure, that the South African equity market could be up more than 20% next year in 2024. Give us your thesis on that.
Yeah, thank you. Yeah, I love to do these sorts of out-of-consensus debates. I think they're very good. So I absolutely do think there's a real possibility that that does happen. Why could it happen? I think with the headwinds that Nancy spoke about, I think obviously that really does detract from the overall total return. But there are many other ways that we can make money. So we have NASPA's process at almost 18% of the overall equity fund. And I think Brian laid out quite a good thought process of how we think China's going to go. But importantly, not only China consumer, but especially China internet companies. And I think when you think about it, Tencent actually produced a phenomenal result, growing its earnings more than 30%, even notwithstanding a kind of lower revenue number, which was not too bad, actually, at around 10%. So you have that big earnings growth. And actually, if you look at the multiple of Tencent, exits investments, it's a 12 times PE. So a company like that with almost 18% in the equity fund can really do some of the heavy lifting. The rest of the heavy lifting is going to be done by the South African incorporated stocks, in my opinion. How will that happen? I think one of the ways is you'll have a surprise on economic growth next year. You'll have a 3% economic growth if we do have a release of the pressure valve of the depressing power outages that we had previously. And you mustn't underestimate the negative impact that you have from the power outages. Obviously, the direct impact is on manufacturing, but the second thing is obviously that the confidence levels of people really do go down when you have the load shedding. And you mustn't underestimate the amount of confidence that gets sucked out of an economy when you sit in the dark. So this illustrates exactly what I was talking about, the first chart. The dotted line at the top shows you the cumulative load shedding that we saw in 2023 versus all the other years. It was huge, and as I said, a huge hindrance to the overall economy in many different ways. What's going to happen? I think 2023, there, as it says, was the worst year. 2024 could be one of the better years. Now, there's still structural issues through time, but I do think things are turning for the better in 2024. Why is that? This is a chart that was put out by Eskom quite recently. Now, this just shows you in technical terms, I won't get into the detail, that almost 7,000 megawatts could come back into the power grid over the next 2 years. Every 1,000 megawatts equals one level of load shedding. So if everything goes perfectly, obviously it doesn't happen that way. We could have 7 additional levels reduction. Now, that means that at the peak of winter, we might escape total load shedding. Remember, what happens also is in the industrial sector, they always sit 2 levels lower than the national level. So there's a lot of good things, and I think this is something that's not just a pipe dream. We have seen the energy minister doing much better. That big orange block at the beginning of Kusile, we've already seen 2 of those come in ahead of schedule, so we're really halfway there on the orange block, and we do think that there's a good move ahead on the power side of things. So that will unleash quite a lot of, I guess, growth if this plays out the way I've laid out over here. Obviously, then you need more than one engine for growth if you're going to do 20% in the stock market. The other one is obviously on the fixed capital formation side. Now, we spoke about China, and that property on its own is almost 20% of the overall economy in China. It's very much lower than that in South Africa. Our government has run out of runway from its balance sheet perspective, and the red line shows you that they just don't have the money to spend on the public sector. What could happen in 2024, which is interesting, is continued growth from the private sector. We have seen Transnet speak about a public-private partnership at the port with the Filipinos, and I think that is a signal that the government is interested to do more of them, and they have shown their intent, and that usually happens when the government runs out of money, that they now do look to the private sector to help them. So that could be a really interesting, I guess, non-consensus view, that you have the fixed capital formation from all of those things coming back, but also some of the renewables that we do know about, which will alleviate some of the power issues that I spoke about. But where you get the supercharged growth is actually the PE re-rating in a year like that. Obviously, you see the black line. We have put this up before, but it's a good chart, so why not repeat it? That the mid-cap index is really cheap, especially relative to the multiple on the S&P. It just gives you a perspective of how cheap our market is. Now listen, there are structural issues. We have signaled them. They haven't gone away. We really do worry about what's going to happen long term. But this is to 2024. We could have a much better power year. And in that, the confidence could be higher and you could have a re-rating. And that will be the enabler of the 20% growth.
Okay, great. Thanks, Nick. Now, of course, Nancy, we do a lot of political analysis within the team, looking at the political landscape and how that might affect our opportunity set. Next year is an election year. In fact, there's 76 countries around the world who have their elections next year. That's actually more than half the world's population. Only 43 are considered free and fair. But let's get back to South Africa. Nancy, how do you think that the run-up to an outcome of the elections in South Africa may support or actually derail Nick's thesis?
Yeah, so I think Nick was quite careful in his analysis to not mention the politics, but he's making an important point, which is really understanding base effects, and sometimes the base gets so low that from an investment perspective, that's really time to look out, because you can easily get growth accelerating if your base is very low. It's not obvious to me, looking at where we think the political party support is at the moment, that the 2024 election result is going to give him that rally or is going to add to that rally. I would say there is a positive scenario that might help Nick get his surprise right, and that would be an ANC-DA functional coalition. And I mean, emphasis on the word functional, because it's one thing to do a coalition and it's another thing to have that coalition work. That could be very positive for South African markets, but at this point I would put that as a possibility and not a probability. So let's put it that way.
Okay, now, Rashad, you've been quite outspoken about the negative trajectory that we've seen with regards to government debt. We've got a worsening of the budget deficit ahead of the elections next year. That's unlikely to turn around before then. What do you think, given that, and obviously sort of the way that you feel about how that's tracking, what is the likelihood that we'll actually have a backdrop that is supportive for economic growth in South Africa?
So I agree strongly with Nick's case that a recovery in the electricity sector, which has been such a massive drag, can provide us with that boost into next year. But the debt problem in South Africa that we've built up is not going away. So we've been in the doldrums from a growth perspective. That's why our debt to GDP has just consistently gotten worse every single year since 2008. If we do get to a 3% level, it can be the first year in a long time where debt actually stabilizes, and that will be a positive boost to sentiment if we do manage to stabilize debt after a long time. The downside risk I think we need to monitor is the election next year, the ANC potentially falling below 50%, and what they could do in the February budget in terms of populist measures. If we see things like NHI being pushed through, if we see things like extra spending on social grants, that may knock confidence and that may push our growth back to its older levels, and that would be a negative and reduce the likelihood of that next year's recovery.
Okay, so before we move on, Nick, I'm going to get you to put your neck on the line. You are the Chief Investment Officer, so I think I'm allowed to put a bit of extra pressure on you. We had Brian talking earlier about how Asia is going to be the top performing stock market. You've also said South Africa is likely to perform very well. Which of the two would you actually choose out of those two?
Yeah, I think it's an important one because we always do benchmark the South African stocks with the global stocks. It's a very important habit to do. And I think the reason why we do it is we have the ability to invest either in South Africa or globally. And when Brian looks at the world, he has so many more opportunities. So when we benchmark a SA retailer to a Chinese retailer, which could be an online like Alibaba, the South African retailers are trading at slightly higher multiples with much lower growth, whereas the Chinese companies actually have much faster growth and actually have a lower multiple. So actually, I'm more excited, even though I think we could do 20% in South Africa, I actually think it's more exciting to be offshore. And if you were to push me, I'd say actually the Chinese stocks, notwithstanding the 20% comment in South Africa, could very well do better than what I said in South Africa.